Welcome back, everybody. We are in our first panel of the Money View Symposium, sixth edition. I'm really happy to see everybody back, and I'm really excited about this panel. It's entitled The Money View of the Past Year. And I think we all agree this was a year we'll talk about for a long time, but and this will be a first hack of digesting it from a number of different perspectives. It's really a free-for-all. So I think we now, after having an extensive conversation between Sven Becker, Perry, and Yakov, I think the goal here is to get into a conversation and bring everybody in, and whatever spills over into the liquidity happy hour, we'll have to stick around for later to really do that. But we have three panelists that I'm really happy to introduce quickly, and then we'll get right into the presentation. Many of you have been longtime Money View people or been to the Money View Symposium previously and need no introduction, but I will be happy to just do that anyway. So, as I mentioned previously, Iñaki Aldasoro, he is giving the first presentation. He joined the BIS in 2016, and he previously worked as a consultant for the European Systemic Risk Board, and that was in 2015 to 16. And he has a previous history working for the European Central Bank and the IMF. Iñaki, we read your work extensively, so you're very much an inspiration to the Money View crowd. So thanks for being here and also for giving the first brief presentation. Secondly, welcome back, Izabella Kaminska, Izzy, as we call her. She's the founder of The Blind Spot. That's a new media venture that she has created a while ago. And previously, we've known her as a journalist at the Financial Times. In particular, we engaged with her in her role as the editor of the FT Alphaville blog. And that was a great time back 2017. I think we talked at our Edinburgh Festival for New Economic Thinking. So that was a good time. Izzy, thanks for being here. And Brendan, I'm not sure if we've engaged through the Money View before, but it's great to have you. Brendan is currently enrolled as a PhD student in the Department of History. And his work there is specialized in the history of money and finance, in particular, the early modern Atlantic world. Brendan, when you come on, I think you can briefly talk about your actual project, because I think this is really the reason we invited you to try to bring you into the community, because you have a tremendously interesting book project with Penguin Random House about the history of the dollar, and I think we are really curious to hear about that story too, besides your comments about the last year. And if Katarina Pistor comes on, obviously you know that she is a professor at Columbia University, and if she's not here, we'll hear her later. But the panel is thought to talk about the major developments of the last year. I've given some pointers to the panel, but I think we'll really leave it to the discussion to flow. So I have no priors. So I believe Iñaki has a good presentation to start us off. Iñaki, I'll hand over the floor to you.
Thanks a lot. Let me try sharing the screen. Can you confirm that you see the screen? Okie dokie.
Yes, we're good. Please go.
Okay, it's good. So first, well, thanks a lot, Jay, for the invitation and the kind introduction. It's always a pleasure to participate in the Money View Symposium. Good morning, afternoon, evening, everyone, depending on where you are. So I've participated in a couple of symposiums in the past, presenting a paper. On this occasion, I'm not presenting a particular paper, and instead I try to sort of provide some background to kick off the panel. And so, especially given the level of expertise of the other panelists, which, by the way, is just such a pleasure for me to share a panel with them. I had to think seriously about what kind of value added I could bring to the table. So I decided to give you a quick sort of data heavy. That's the value added I can bring, a data heavy presentation that tackles the topic of the panel through the lens of stablecoins, which, as you all probably know, have been front and center in various policy discussions around the world, and are also the subject of a lot of ongoing debate. So I will take stock of where the market is, the role stablecoins play, and also provide some evidence from ongoing work about the linkages with the traditional financial system. And as usual, before I begin, let me remind you that whatever I say today reflect my views and not those of the Bank for International Settlements. So with that now out of the way, let me go through a series of stylized facts to present some background on the market. So first, you can see on the left panel that stablecoins are a small part of the crypto ecosystem in terms of market capitalization. Now, I have some issues with measures of market capitalization for crypto assets, especially AMBAC ones, but let's leave that aside. Point being that you can see the yellow part is relatively small. Now, despite having this relatively small footprint in terms of market cap, they have become the principal settlement media within the crypto ecosystem. And this can be seen in the right panel, where stablecoin turnover dwarfs that of other cryptocurrencies such as Bitcoin or Ether, even though, again, the latter, Bitcoin, Ether, etc., especially Bitcoin, accounts for around, together with Ether, around 3/4 of total market cap. So that's fact number one. Fact number two is that, and that speaks more to what happened, especially over the past year, is that the market grew quite a bit. In the left, you see market capitalization for stablecoins. So zooming in on what I shown in the left panel in the previous slide, where you can very clearly see the dominance of Circle and Tether. And you can also see clearly that growth was underway in 2024, but got a boost with the US election in November 2024. And it also got a further boost with the passing of the Genius Act in July 2025. The boost was evident both for stablecoins that would be operating within the Genius Act mandate today, and this is what we call compliant stablecoins in the center panel, but also for those that are not, which we term non-compliant in the right-hand panel. At the same time, it is also quite clearly visible that the market has basically starting in early October 2025. This happens to coincide with the peak in Bitcoin prices, which have gone down by about 50% since I think the peak was around 7 to 10 of October. I can't remember exactly. This kind of foreshadows a point I will go into a bit more detail shortly, namely the use cases of stablecoins. Now, a third point to note, which was already obvious from the previous graph, once you know that both Circle and Tether are pegged to the US dollar, is that the market is overwhelmingly denominated in dollars. In terms of the pure number of stablecoins, that's the graph on the left, you see that those pegged to the dollar account for around 2/3 to 1/4 of the market. Now, when you take this in terms of volumes, that's the graph on the right, then dollar dominance is even more staggering. That's around 98% of the market is pegged to the US dollar by volumes. In fact, the dominance of the dollar in the stablecoin market is staggering even by the standards of what we know from traditional financial markets. So this is a variation and expansion of a graph that you might have seen in the past, where we show basically that the dollar appears on one side of close to 90% of all FX transactions, accounts for roughly 60% of cross-border bank claims, nearly half of international debt securities, more than half of identified official FX reserves, trade invoicing, SWIFT payment messages, and also interest rate derivatives turnover. And in every case, the dollar share here substantially exceeds the US share of global GDP, which underscores, the international role that is also sustained by factors that certainly have to go beyond the US economic weight in the global economy. Now, against this backdrop, once you contrast this with the 98% of stablecoins, so it's even much more dollar dominance, one could argue that stablecoins' immediate impact appears likely to sort of reinforce rather than challenge existing currency hierarchies, particularly dollar dominance. And this very much aligns with the own statements by officials across countries. Now, it's big, but at the same time, it's always good to have some perspective. So in our paper with Perry and Dan Nielsen a couple of years back, we drew analogies between stablecoins and offshore dollars or euro dollars. This is something that, in fact, was pioneered by ISA in the mid to late 2010s in Alphaville. So in this graph, what I try to do is to use BIS statistics to compute measures of offshore fiat money for the major currencies for which we have information within the BIS banking statistics, and also included stablecoins for perspective on the right panel. So as Perry likes to note, it's the dollar world. So, offshore dollar liabilities booked by banks outside the US are around 14 trillion. This dwarfs the current stablecoin market. However, stablecoins have grown to exceed, for example, offshore Swiss francs, especially given the recent increase. Now, of course, there are some similarities in between instruments in that both offshore dollars emerge out of a combination of financial innovation and regulatory arbitrage in a manner that is not that different from stablecoins, also emerging out of financial innovation and regulatory arbitrage. However, offshore dollars or offshore fiat money more generally tends to operate within traditional banking channels and are ultimately backstopped by central bank swap lines. And this stands in contrast with stablecoins, which circulate as bearer instruments on public blockchains, accessible largely outside traditional financial and banking regulation, and so far at least without explicit backstops. And this is a structural difference that makes stablecoin potentially more disruptive, especially once one starts to think about the role of capital controls and foreign exchange regulations, even at a smaller scale as they are, or comparatively smaller scale as they are today. Now, very briefly on reserve portfolios, for those that are not familiar with that, though I know that my fellow panelists certainly are, and many of you might be as well. So stablecoin reserve portfolios exhibit some heterogeneity across issuers, but there is quite a bit of concentration in US dollar denominated instruments for the dollar peg arrangements that dominate the market. So essentially Tether and Circle. So if one compiles evidence across the largest coins, then this shows that these issuers typically hold some combination of reverse repos, publicly issued debt securities, mostly US Treasuries, and some sort of cash or cash equivalents in varying degrees or varying proportions. So for instance, Tether, it was notorious for its lack of transparency on reserves and was rumored to hold low quality private commercial paper back in the day. Now holds a significant share of its reserves in US Treasury bills. So that's within the 0 to 3 month maturity range. It is also quite unique among the major players in its continued holding of other cryptocurrencies and other volatile assets. USDC, the second largest coin, holds a mix of treasury bills and overnight reverse repos. And PayPal USD, for example, is doing mostly reverse repos. Now let's move to use cases. So stablecoins are chiefly used as a settlement media within the crypto ecosystem. There, they function as the base leg of trading pairs on both centralized and decentralized exchanges, and also as a principal store of liquidity between speculative positions. And as I mentioned earlier, the turnover typically exceeds that of major unbacked crypto assets, and this is consistent with the role in market making and arbitrage. Now, much of stablecoin turnover is, however, automated activity between bots, intra-exchange transaction, also to some extent wash trading. There was a very nice academic paper published 3 or 4 years back about this. Now, information is typically hard to come by, but the available data that attempts to correct for these activities yields an adjusted measure of stablecoin transaction volumes that is significantly smaller than the numbers that are usually quoted in the press to argue that stablecoin activity dwarfs that of established payment services that support the real economy. Like you get these headlines of now they are beyond Visa or beyond MasterCard, this kind of stuff. And this is what we show in the left panel here in this graph. Now, in the right panel, we zoom into the adjusted transaction volumes, and then we see that most of the activities are not done by retail players. And this puts into question also industry claims that stablecoins are used for example, remittances. You can see that the retail size transaction is in the legend, but the actual red stuff is very barely visible, with a share of around 0.5%. Now, beyond trading, stablecoins are also embedded in decentralized lending and liquidity protocols, where they serve as also collateral borrow instruments. Why they're used for goods and services kind of depends on deeper integration with existing rails. It would also depend on regulatory clarity on redemption rights, consumer protection, also the economics on and off ramping, and also foreign exchange conversion. Now, much of the stablecoin usage so far remains sort of attached or tethered, if you want, with the pun intended, to crypto activity itself. And this evidence is also consistent with survey data that we have collected here from Boston Consulting and Visa as well. Now, so I paint sort of a negative picture now in terms of use cases. Now, despite these issues around the use cases, this does not mean that they are not relevant, nor that they don't have already measurable effects, let alone potential effects, which justify many people worrying a lot about those potential effects. So I will cover 3 issues related to measurable effects so far. One is capital flows, then it's linked with safe assets, and the third is the links with foreign exchange markets. So this is drawn by work by BIS colleagues that has shown that the use of stablecoins in cross-border payments has grown, especially in corridors where legacy correspondent banking tends to be slow or costly. Now, there are, of course, issues with measurement here. It's challenging given the pseudonymity and the fact that there is a lot of activity that is centralized in exchanges. There are quite a few approaches to get around that. There is this paper by BIS colleagues. There's also a very nice paper by people at the IMF. There's also work by Chain Analysis, which is a data provider. That's also quite nice on this. There is, in general, some sort of consensus that from early 2022 onwards, cross-border flows in the largest dollar-pegged stablecoins have grown quite a bit, and also at times have surpassed those of Bitcoin and Ether prices. This is not what we show in the left-hand panel. I took out the Bitcoin and Ether, but in the paper itself, you can have a graph. You can see a graph also with Bitcoin and Ether. And in the right panel, what the colleagues show is that cross-border adoption tends to interact with macro-financial conditions. So when you think of economies with weak monetary frameworks, high inflation, in such economies, foreign currency stablecoins can serve as a de facto store of value and also potentially as a de facto payment instrument. And this has, of course, implications for currency substitution, monetary sovereignty, and also for the effectiveness of capital flow management measures. Now, notably, 2 of the most significant country-level drivers that the work of the colleagues of the BS colleagues has found is, namely, high inflation and exchange rate volatility, are typically hallmarks of what the literature on international monetary hierarchies terms financial subordination. And this suggests some sort of self-reinforcing dynamic, right, where you have economies that are already financially subordinate that face conditions that make private sector stablecoins adoption more likely, and then widespread adoption in turn risks sort of entrenching a new digitally mediated form of financial subordination. Now, much more than in capital flows, stablecoins already are a relatively large player in treasury markets. They hold and they have holdings of stocks, but also purchases in terms of flows of treasury bills that are on par with the largest US government money market funds, and also larger than most foreign purchases. There was I'm pretty sure Isa went through this in social media with the report of Tether that came out about a month ago in terms of how much they bought last year and the profits that they made. I have a recent paper which we actually updated a few days ago with Rashad Ahmed, where we document that inflows into stablecoins generate. So think inflows into stablecoins. Think about the market growing, like market cap of stablecoins growing, generates downward pressure on treasury bill yields in a manner that is highly dependent on liquidity conditions in the market. So when liquidity is plentiful, the effects are sort of barely visible. This is what we show in the left-hand panel. When liquidity is low, instead, the effect is considerably larger and also statistically significant. So we have a few measures of liquidity in the paper that we use to look at liquidity regimes. Here we are drawing from recent research published in the Journal of Finance, where they look at liquidity, state-dependent liquidity conditions by assessing the state of the overnight reverse repo facility with the Fed. Stablecoins have also implications for FX markets. One can think of them as a sort of a new parallel ecosystem that interfaces with traditional FX markets. And as such, they give rise to no arbitrage conditions that are similar to traditional financial markets. So if you think of an agent in an emerging market that is seeking to buy a stablecoin using its local currency, she can do this in 2 ways. So she can do this directly by using her local currency to purchase the stablecoin, say at a centralized exchange, at the price that will be quoted in units of local currency per stablecoin. But she can also do this indirectly by first using the local currency to buy dollars at the spot FX rate, and then using the dollars to buy the stablecoin at a price that is quoted in dollars per stablecoin, which is presumably going to be a more liquid market. Now, in principle, if we have a frictionless, fully integrated market, then the law of one price will dictate that the cost of the two routes should be equivalent. And then when the two routes yield different prices, then we refer to these as parity deviations. We call them in forthcoming work. This figure here plots those parity deviations for a subset of currencies. It is taken from forthcoming work that I'm doing with IMF friends, where we use granular data on 4 USD pegged stablecoins traded against 27 fiat currencies across a few dozen exchanges. And for some currencies, these deviations average several percentage points and exhibit significant volatility. Now, also interestingly, the parity deviations from a no arbitrage condition are systematically larger for currencies of economies that experience macroeconomic instability. I think, high inflation, or that employ capital flow management measures, or that are otherwise compromised by some sort of macroeconomic instability. In the paper, we also causally identify the effect of the positive effect of stablecoin inflows on those parity deviations. So more inflows, say, into Korean won related trading pairs in stablecoins will lead to more deviations for the Korean won. We also show that more inflows lead to traditional FX depreciation. So the Korean won will be depreciated in traditional FX markets, and will also lead to wider CIP deviations. So I'm not showing that in the graph. So with that, let me leave it here. So here are the papers on which I base my presentation today. For those that are interested, a couple of them should be out fairly soon. One of them is already out, and I'm happy to share up until the point in which they come out. Thank you all for your attention, and I very much look forward to Isa's and Brendan's remarks and the further discussion.
Thank you, Iñaki. We move over to Izabella.
Hi, thanks for having me. For those who don't know, I've spent nearly the last year diving very deep into stablecoins. I'm trying to pivot my operation into something I've called the PEG, which focuses on covering everything that goes on in that area, plus sort of derivative aspects of it. I mean, I haven't really prepared anything, so I'm based on the notes you gave, I thought I'd just give a little review of what I think are some of the more interesting developments. Obviously, post Genius Act, post MiCA, post sort of the slow shift of stablecoins into the realm of respectability. For me, I think it's very interesting how banks are obviously embracing stablecoins. One of my priorities for the next year is looking at how banks are going to be operating in stablecoins and whether it really makes sense for them. Obviously, they face multiple options, tokenized deposits. There's digital euro coming in Europe. And yet we are seeing these ventures like Covalis. There are other bank-led consortia all over the world now looking to get into stablecoins. I don't know if Iñaki has looked at this in any great detail. I'd love to know if it's something that the BIS is watching. But I'm very, for me, the big trend there is this idea that public blockchains are now respectable and usable by banks, which certainly wasn't the narrative 4 or 5 years ago. 3 years ago, I think R3, one of the biggest blockchain consortia, was very adamant that banks will never use public blockchains. And yet here we are, post-Genius, it very much like, sorry? Oh, I heard something. Anyway, it looks very much like banks are starting to embrace stablecoins, largely, I think, because they offer cost advantages. and being able to outsource a lot of settlement, cross-border settlement, especially to blockchains, seems very enticing. Whether that is a good idea in the long run, I don't know. I certainly wonder if there's enough academic discussion, regulatory discussion about the degree to which, under that framework, I would argue the cost of settlement is outsourced to speculators in cryptocurrencies. Ultimately, whether it's Tether or Circle or any other Paxos, any other sort of even a well-regulated stablecoin using public blockchains effectively, in my opinion, outsources the cost to the crypto realm, just because of the native tokens that are effectively power the whole thing. And now we are in another crypto winter. We've seen volatility return. I think up until recently, there was discussion about how Bitcoin had matured, and it was going to be this boring stable currency from now on. And then, of course, just as people were saying that, it started to get volatile again. So far, Bitcoin has withstood a lot of that pressure. It's withstood many crypto winters, so I'm not convinced it's going to collapse. But of course, so many of these stablecoins run on derivative, or rather, like all sorts of different weird blockchains, Tron, Solana, Ethereum. There is an entire kind of universe of alternative blockchains that these things run on, and obviously interoperability between them is very clumsy and complex. And I wonder if banks are really prepared for. I mean, they have to think very carefully about which blockchains to use, and I don't think there's enough discussion about the resilience of the underlying blockchains that they are using. Secondly, obviously, this week we've seen the entire crypto world go nuts over this story about the Terra Luna, the sort of revisionism about what really happened with Terra Luna. And I think from the perspective of ongoing regulation, especially here in the UK, we're still trying to nail down the future regulatory conditions for stablecoins here. Terra Luna, I see as a sort of, even though it was an algorithmic coin, it is referenced almost, I think Inaki's referenced it. Everybody references Terra Luna, and it has become a sort of poster child for the risks embedded in stablecoins. And I do think it's worth revisiting some of those conclusions, not to suggest that they're not accurate. I think there's obviously, even if it was an insider trading situation that triggered the collapse of Terra Luna, which is what the allegation now is, obviously it was still not resilient enough to withstand such an attack. But and I don't think money infrastructure should be created in a way that allows for insider trading to collapse it. That said, it happened to the BOE, I guess, with Soros, but that's a different story. Not insider trading in that case. But I do think it merits sort of academic reconsideration of what happened. And of course, in your notes, you suggested talking a little bit more about the role of the dollar in the stablecoin universe specifically. I mean, I'm very interested in the sudden sort of change in mood that I have detected in Europe. It seems Joachim Nagel is now saying some nice, warmer, fuzzy things about euro-denominated stablecoins. I wonder to what degree that is really going to become a thing if the ECB decides to, until now, I think they've had a very, I guess, cautious approach to the whole thing. Obviously, their focus is on the digital euro, but it seems like there is some sort of slow recognition, and I wonder if the push is coming from the banking sector and some of these consortia that are keen to go ahead with euro-denominated stablecoins, whether there has been a sort of change of heart in terms of how the international role of the euro can be expanded based on stablecoins, and whether or not stablecoins will get access to sort of European euro liquidity is obviously a key part of that. For me, the euro stablecoin story has always been complicated by the fact that Europe doesn't have a single sort of underlying, government bond that can secure it. I always thought that there was fragmentation risk with euro stablecoins. For that reason, I suspected that was why there was a preference for digital euro. But we have to watch and see how the kind of wider geopolitical situation evolves. If we see more Eurobonds coming onto the market, I think that introduces a more viable path for euro-denominated stablecoins, and that is something I will be watching. When I chatted with Stephen Myron the other week, I did ask him about whether he thought it was a potential challenger to the dollar. He wouldn't be drawn on it. It was very kind of he seems to think that the dollar will continue to reign supreme regardless. And I think the general perspective there is that stablecoins will provide a great mechanism by which US dollar debt can continue to have a bid in the international market. And I think I'll just end on the point that, and I'd just invite you to ask me questions, because I have many thoughts about many things, and I think there are lots of very interesting developments in the weeds, which I'm not sure the kind of academic community has really picked up on yet. Amongst them is this new phenomenon of stablecoins being collateralized with other stablecoins of stablecoins. I mean, it was inevitable, really, wasn't it? What risks that poses. But I think also in terms of the bid, whether or not stablecoins can actually sort of save us from a debt doom loop, I think it's largely overlooked, because I've read many kind of analyses that suggest that actually there might not be an incremental net sort of demand, because it just shifts demand rather than increases new demand for debt. But I wonder if that analysis has paid attention to the leverage inside the stablecoin universe. I think there is actually a lot of leverage, and as a result, that creates a mechanism by which you do add demand for underlying bonds and assets. And I think that deserves more study by people who understand like the quantity math stuff that I don't. But please ask me more questions if there's anything else that you would be interested in specifically.
We definitely will, Izzy. Thank you so much for the input. Very great to see that you're working on this and shifting to this realm. I think it's time to bring Brendan into the conversation.
Sure.
Who is my former colleague. So hello, nice to see you again.
Yes,
I did forget to mention that at the beginning. Sorry about that. But please introduce yourself once again, Brendan, if you like.
Sure. I'm so happy to be on this panel with Izzy, my former boss, and Iñaki, my best friend on the internet. So I was a financial journalist. I covered the Fed for Businessweek and Financial Times. I'm now sort of retraining as a financial historian. I just finished a history of the dollar, which means that I've spent the last year reading the news and screaming into the void, often with Iñaki on the internet. So I think what worries me the most about the last year is the U.S. embrace of stablecoins, and particularly the decision to give it back to the states, rather to take regulation and let states compete to attract stablecoin providers. I think that's going to be a disaster. But I think I can explain why using a money view. I have found that it's really difficult to write about monetary history because everybody has terrible ideas about what money are that they learned in college. And so what I found is to write a popular history of money, what I have to do is sort of this shuffle where I say, okay, remember what you learned, and then you jog their memory, and then you go, okay, that was all wrong. And so I'm doing this again and again and again. And so I arrive at the end of this book at what I explicitly say. So here we are at the Perry Maryland money view, but it took 125,000 words to get the reader to the point where they can understand what that means and why it's significant. I think one of my biggest challenges is that there are not great definitions of monetary sovereignty. It feels very hand wavy to me. Sort of, it's supposed to mean control of a country's money, but there are a lot of assumptions behind it that I don't find very useful or very helpful or very precise. So, in the economist view, the macro view, the Fed produces dollars, doesn't matter how, fiat. And even in the MMT or Chartist school, it's really the Treasury that produces dollars, but it doesn't really matter, fiat. And I just don't find the word fiat that helpful because it starts with an assumption of sovereignty, right? Monetary sovereignty is something a country has, and it's something that it can only lose if it performs poorly. I don't think that has been very useful for me writing a history of the dollar. But I think in particular, it's not useful now because if you accept that definition, and most policymakers do, then a stable coin is something novel. It's private money. I think most of the people here would agree that a stable coin is not something novel, that it is something that we've seen before, and that in fact, all of our money is private already. This is something I often have to explain to people. I actually explained to an undergraduate who was in his fourth year of an economics degree that banks produce money, and we got done sort of me working through that with him for about half an hour, and he said, "I can't believe they're allowed to do that." And I said, "I can't either, but it is true." Okay, so if we historically see the dollar as sort of a series of financial claims, almost all of which were generated privately, you have promissory notes, bills of exchange, commercial bank notes, commercial bank deposits, checks, there are other financial instruments. But you see this sort of tremendous heterogeneity, different kinds of dollars. I think that's still true today. But we can't see the heterogeneity. And the reason we can't see the heterogeneity is that most of these instruments that we use now as dollars, at least domestically in the US, they clear at par. And it's easy to assume par, because for people who work at universities or work as policymakers, all of your dollars actually function. They clear at par. So you don't have to think about what par is or how we got there. But par has a history. And if we look at the history of the dollar, the US dollar at least, it had to be acquired crisis by crisis. And it comes out of financial regulation and enforcement. I sort of think of three major financial crises to help frame this: 1837, 1907, and 1932. Each of these crises showed the weakness of an approach where you let the American states, regulate their own dollars, their own bank dollars. And each of those sort of inspired new kinds of regulation. We built historically this framework of regulation, crisis by crisis by crisis. 1837 was financial panic. It was because of the cotton market, but banks stopped redeeming their notes for Mexican silver. They slipped out of par. And so, historically, we think of banknotes as chaotic, but they weren't really. Private banknotes cleared at par in most cities. People would write out contracts for banknotes of this city. It was an assumption until 1837 that they would clear at par. They slip out of par during a financial panic. So you get these experiments in what are called hard times monies. Cities are printing their own dollars. Their own dollars are also these sort of complex financial instruments. They rest on future tax revenue, but you also get a response. You get reserve requirements at the state level. You get banking disclosures. You start to get these reports at the state level of sort of what bank balance sheets look like. But you get free banking. We're trying to get out of this crony system where people got banking charters if they knew somebody in the legislature. But you still keep this state banking system. There are a lot of crises. In fact, there's so many crises in the 19th century that one thing I have not told my children, I have 4 children, their Apple passwords to get more screen time are actually banking crises. So one of them is 1819, one of them is 1837, one of them is 1857. And if I had more kids, there were plenty more crises that I could use. But if we go to 1907, there's a problem in the copper market in New York. But again, you get that ripples out. You get rural bank failures. They find it impossible to get national banknotes for their deposits. They also slip out of par. They close their doors, right? So you get a response to that. You get the Federal Reserve. And originally, the goal of the Federal Reserve was a more flexible currency. It was supposed to do a couple of things, but significantly for this argument, it was supposed to make sure that national banknotes can get out to the state banks on demand to keep the state bank system afloat. 1935, pick your reason for the Great Depression. I prefer collapsing global commodity markets, but I'm not prepared to argue that with anybody. You get banks closing their doors in 1932. State banks, again, in particular, they cannot discount their assets to get Federal Reserve minutes. Same thing happens. Again, this is a 100-year-old problem. Deposits slip out of par. Again, you get experiments in hard time money. Cities are printing their own dollars. This happens all over the country. Response, you get national deposit insurance. You get a more political Fed with the Banking Act of 1935. So this understands it has a democratic obligation. So what I sort of see when I look back is constant testing of par, constant collapse of par, and a framework of regulation that's built up crisis by crisis by crisis until we have a system that we can recognize today that makes sure that when you have a US dollar, it is a US dollar. Now, this system is imperfect. It doesn't work for a lot of people now. A lot of people aren't in the banking system in the United States. A lot of people are in the bank system, but transfers in the United States are hideously expensive. The challenge is what we have now with stablecoins is a largely uniquely U.S. Response, at least inside the U.S., which is, ostensibly, stablecoins are supposed to be a state-led response to problems with the monetary system. There are real problems with the monetary system. The problem is other countries have solved this. Other countries have made transfer payments cheaper. Other countries have brought people into the banking system. What we have instead in the United States is, because we have such bad popular monetary history, because policymakers have such a poor sort of framework for thinking about what money is, we have this brand new legislation that recreates the conditions that underlie all the crises I just went through. That's my scream into the void. Right now, actually, the noise that you hear behind me and this weird light installation is the cafeteria of the National Archives in Kew in London, where I'm working on a dissertation about the Guinea. And Iñaki, in about 2 years, I'm going to make you read it.
You're in Kew.
I'm in Kew. We'll catch up soon.
Sorry, I'm just around the corner.
We'll catch up in about half an hour.
I'm sorry to jump in, but I'm very interested in what you said, Brendan, about the idea that stablecoins mostly cater to a US problem, because when I speak to the kind of the murky people behind Tether, they insist that really the demand is all outside of the US.
Sorry, I'm sure that's right. And Inyaki's data shows the same thing. I don't want to dismiss the global nature of dollar stablecoins. My argument is from a U.S. regulatory-based approach. My frustration is specifically with the Genius Act that gave regulation of stablecoins back to the states. So yeah, absolutely. There's a problem. I didn't have. I think I took 10, 12 minutes. I just didn't want to get into what Iñaki had already walked through, which is sort of the way in which stablecoins are recreation of euro dollars. I absolutely agree with that argument. It makes total sense to me. My frustration is, the lack of a money view in the United States among policymakers, which makes it possible to say, we're going to have state-led regulation as if we haven't done this before.
Given that we are internet friends, Brendan, so I may just bring up a meme that I've seen in relation to what you said, which is, men will invent a new form of money rather than regulate interchange fees. And I think that kind of speaks to the angle that you were making in terms of why it is a U.S. phenomenon. I do agree with Isa, though, that it is U.S. based and might be like a strong U.S. angle. Concerns from all over the world are very much the order of the day, I would say. So it's very much an area of concern for many non-U.S.
And I think maybe we can get into this a little later. I think the most likely outcome is that there's going to have to be a U.S.-led rescue of a global collapse of stablecoins, in the way that the Fed sort of uses its swap lines to bail out privately produced dollars during crises already. I see that as almost inevitable.
So I wanted to pick up on a theme that Isa mentioned on the net new demand. So I think, looks like when we wrote the paper and like the estimates that we have, for the impact of stablecoins on treasury market, they are based mostly on the data from history up until today, right? And then the market grew from nothing to 300 billion or so. Now that growth was sort of organic and fairly decentralized and coming from money that was not exposed to treasuries otherwise, mostly. And that's why I think you find these comparatively large effects that we find. Now, if you buy the story that the market is going to grow tenfold to 2 trillion, 3 trillion, that cannot be sustained by, my fellow Argentinians buying $100. There has to be through institutional money. And if it's through institutional money, then the likelihood that will come from pools of money that are already invested in treasury bills, either directly or through a money market fund, is quite likely. So I think the effect going forward, if the market is to grow, which is very much an open question, it's probably going to be smaller than what we identify. Because I cannot see the market growing. I cannot see like a 3 trillion market that is going to be sustained by your average Venezuelan and Argentinian or Lebanese people protecting themselves from inflation and the like. I do wonder about the point that you mentioned about leverage. So if you could elaborate on that, because I'm interested.
Yes, so I think there are 3 pools of demand for stablecoins. One is I do believe it is true when Teva says that the vast majority of their kind of long-term holders are communities living in jurisdictions that have unstable monetary regimes. Turkey is a key area. Iran has been noted. I think there's possibly more going on in China than people care to admit. The fact that they never answer my questions directly about China, I think suggests that there is some element of business over there, but obviously outside of the purview of the Chinese authorities. And I think Europe as well. I think there's a lot of European holders in some of outside of the Eurozone. So, but in terms of the second big pool, it's always been sort of the crypto trading side of it and conventional trading. But now the third pool, I think, it's already emerging through these DeFi platforms where leverage is up to 100x. And the key collateral for all those exchanges are, stable coins. Different platforms use, different stable coins. So like one of the big ones is Hyperliquid. So after FTX collapsed, Hyperliquid became a massive platform, largely because people didn't trust centralized exchanges after FTX, and it popped organically, supposedly, and their preference is USDC, and they effectively you can keep your collateral there and 100x it, and that against all sorts of different trading. So it gives you and you can punt on other stable coins as well as on collateral. You can punt on absolutely anything. So that in itself creates more and more demand, I think, for stable coins through that leverage factor because of the mechanics. I can go through it with you with you one-to-one, but it's through the mechanism of perpetual futures, and that that specifically, I think it's underappreciated how much extra demand is coming from that side of things. And perpetual futures are now, we can argue whether they're a real innovation or not. A lot of people say they're not, but I think perpetual futures are a really fascinating development, and they effectively allow for intraday liquidity funding costs to be priced through the market. And that is where people just like, it's this staking situation. You don't even have to take a punt. You can just make money from satisfying high funding rates. So you put your stable coins in when there's a big funding rate, and you can earn interest that way. And so I think it's an area of interest, especially as perpetual futures are now, there is a movement to try and regulate them. And if perpetual futures become a thing that institutions can go into, I suspect that will lead to even more demand for stable coins. So that's the primary mechanism. And I think the third mechanism is probably actually some sort of payment, just pure float for payment purposes, rather than store of value.
Yeah, when you mention this, of use for leverage and reuse for leverage and stablecoin being collateralized with other stablecoins, to me this brings to mind the layering argument of Minsky that Dan Nielsen in his book
yes, exactly,
put out so clearly. So it's exactly that. Basically, it's like you have some sort of scarcity of some money, and innovation creates new forms of money that pile on the same original claim. That's just basically the house of cards building up.
It's 100% history repeating itself. But at the moment, DeFi is sort of a no man's land, which is very hard to regulate. And when you're, I think one of the problems with stable coins is that you can regulate domestic use, but once you have a stable coin issued and available for circulation, it's very difficult to constrain where it goes. So, there's endless opportunity for me to kind of, if I'm a punter, to take my real hard, fiat dollars and keep turning them into stable coins and putting them in DeFi into all these leverage products, and effectively engaging in that layering for effect, which in turn creates a bid for underlying treasuries, because every time that happens, due to the interest differentials, the issuer stablecoin, the stablecoin issuer has a sudden need to feed more. There's effectively an arbitrage, very much like with ETFs, and the liquidity providers between the two asset classes will want to take advantage of the differential, which is how I think you end up feeding new net demand into treasuries as a result of that. Again, I said yesterday on the back of the Terra Luna thing, like stablecoins to me are just a new iteration in some respects of the ETF model, and it's just a question of how exotic they're going to get. ETFs have got very, very exotic, but the same issues, the same exact sort of issues in terms of like reserves and transparency. Like back in the day when ETFs were new, there was very little transparency over their reserves. The original ETFs were some of the biggest ones were not just stock ones, they were gold-backed ones. And now we obviously see the rise of gold-backed stable coins, and Teva getting very much involved in the gold world. I think that's the other area that merits some academic study, is like, why are the stablecoin companies pushing ahead with gold-backed stablecoins? I think there's some sort of regulatory arbitrage opportunity there because of how bullion banks have been. I can't remember which particular rule has constrained bullion banks, but that rule does not apply to stable coins. And so I see them as evolving in a shadow bullion bank sort of way. And I don't think they're in the market yet in terms of lending gold, but they might be. Certainly, there's a lot of interesting developments. Teva has hired a big team from HSBC to be their main gold trading guys, and they obviously have two key areas. They have the gold that they have to buy and source for the official Teva Gold stablecoin, but they also buy and sell gold for their own account from the retained profits that they have from the stablecoin. And so that's been one of the biggest trends this year, is that they've been piling into gold, and they have also been buying stakes in gold mining royalty companies, and looking now to issue dividends in gold terms rather than in dollar terms. So there's a lot of stuff going on. How that leads to net demand. I mean, Alphaville actually Bryce Elder did a nice story about the idea that Teva's giant, crusade in gold markets may have led to some sort of, it might have helped trigger a bit of that gold bull run. I'm not convinced it's entirely Teva. But obviously gold is a highly illiquid market, and it doesn't take too much at the margin to push it around. So there are stability concerns, not just in terms of what they're doing in US Treasuries or government bonds, but also in commodity markets like gold.
Nice. Brendan, I'll bring you in just a moment. We're at a
Sure.
moment where we're gonna start bringing the audience in, but let me quickly summarize the points that have already been made. For those who are new to the stablecoin conversation, obviously there's been the perceived an announcement of new stablecoins that haven't been announced previously. We talked about the big ones so far, but I think there's corporates right now announcing them also, and I think there's more platform, say Google or other platforms getting involved also, that we haven't touched on that aspect just yet. And of course, there are the various regulatory stances, Europe versus US. Europe having a sort of caution, a protective stance, obviously, in US, and an expansionary stance on stablecoin. It's not, and then I think the thing that's standing in the room here, and I think we are interested in the MoneyView. We've known that there's an offshore dollar system, which is a euro-dollar system. I'm really also interested to see how that interacts, how the stablecoin now. Obviously, the paper that Iñaki, Dan, and Perry have written, they've framed stablecoins in the sort of offshore dollar frame. I'm curious how that interacts. So I think the thing we have to sort of maybe, or to advance the conversation, discuss is, besides the U.S. strategic imperative to sort of stabilize treasury demand, what are the new business cases now for, let's say, Walmart or others coming into the space to, besides reducing costs? There's, in the European context, there is a European-backed stablecoin being announced by European banks, by 6 or 7, led by ING. There's in Europe, Klarna announcing a stablecoin, a shift on, but that's a USD-backed stablecoin. These are all being announced; they're not just rolled out. I'm just seeing a lot of announcements everywhere, besides the ones that are already out there. So I'm wondering if we can also figure out what are the problems and the business cases that these initiatives are all seeking to resolve. And I think another big question in the background that we have to pose is, how does I'm not sure if you've done any work on this, but does any of the AI invoicing now flow back into stablecoin? I think there's a big business case for why AI and compute will be maybe in the future be invoiced in stablecoin because of the fast settlement that's possible. And I think that's another question I have. But Brendan, you come on in, and then we bring in Perry and the rest. We have about now, we're running out of time, but I'd like to bring it
I had a question for both Izzy and Iñaki, but I'll defer. We've got a lot of questions from the audience. I just wanted to say, Izzy, your point about taking dividends in gold just made my head explode, because I am here at the archives at Kew because the coin we think of as the guinea was supposed to be originally a dividend payment from the Royal African Company. That's how it entered the English economy. And I've been spending the last 5 days looking at spreadsheets, looking at ledgers from the Royal African Company, where the dividends had to be paid in gold, no matter what other kind of monetary exchanges they were using to buy and sell the rest of what they were what they were moving. But anyway, go ahead. I'll give it to Perry. I can talk to Izzy anytime I want.
Yeah, go ahead, Perry. Then.
So
we're not so constrained in time, but we can all have our
well, I just have a very brief intervention here. So Izzy spoke about the perpetual futures and about the interest differential, and so therefore the arbitrage. So I just want to remind everybody, that. So this is again about the analogy between the eurodollar and stablecoin. That the eurodollar interest rate has always been higher than the onshore rate. Okay. So that arbitrage, is what supported the offshore dollar system. And that same arbitrage is what's supporting the stablecoin operation. Now, why is the eurodollar rate higher? Why is the stablecoin? From the money view point of view, this is really about deficit agents in the settlement having to bid up, in order to keep the money. So that's what's going on. So I would say that the fact that stablecoin is having to bid up is actually a sign of weakness, not a sign of strength. Let me stop.
I mean, that's exactly it. I think you've articulated it much better than me. But it is that interest rate differential is exactly where the speculation is happening. And you're right, like the returns are absolutely crazy compared to conventional returns. That said, they're also quite volatile. So sometimes you'll get it operates very much like a FX swap, because
yes.
it can go negative sometimes as well. But when it's positive, it's really, really positive. And so
I just remind you of my paper with Iñaki and Dan, where we were connecting the interest differential, okay, to the inflows into stablecoin. Okay, they're just that's what happens. This is, you protect par. So you mentioned par, very important. Our paper was called On Par. So the you protect par in the cash market by not having par in the forward market, which is the interest differential. That's what's going on.
That's exactly right. And so when there's any pressure, you have the market effectively pushing that rate so high that it draws in new underlying collateral to feed the new kind of stock and flow, whatever, that supports the whole infrastructure. Yeah, I find it fascinating. I also think the next stage is when they might just go straight into interest rate only differentials. Like they won't even bother with FX swaps. I think that's possibly coming. Speaking to some entrepreneurs, they're looking to develop effectively opportunities to trade interest rate swaps through these DeFi systems purely. but it's definitely underexplored. So I really encourage academic work, so then I can understand it better from the academic perspective, because I'm just there kind of feeling around in the dark as a journalist. But I sense there's a really big story there.
Yeah. So interest rate swaps, it's equivalent. So I'm not surprised they're doing that. Yeah.
So in simple terms, is it defensible to say the big push over the last year in the mainstreaming of stablecoin is a consequence of the U.S. regulatory stance? Is that a main driver? Why would it explode so much this year? And why is the adoption being driven also by new actors now, like corporates that have otherwise not been interested in this before? You mentioned cost benefits. Obviously, the cross-border payments are a huge factor for why stablecoins have an actual advantage over, let's say, SWIFT or other payment systems. But I'm still trying to figure out exactly what now the end game for corporates might be, or for other actors besides retail. The retail investors that are, or retail customers that are shut out from the Eurodollar market, that's an rationale that makes total sense to me. That's an untapped market because they don't have access to, let's say, Barclays in London, who are able to issue US dollars in your country if you're Argentinian. But what about everybody else? If you don't look at this retail customer, who else, and these illicit businesses, who else has now a real business interest in this and in adopting it further?
I mean, I would say that so one thing that struck me with what Stephen Myron has been saying is that stablecoins allow for what are implicit soft capital controls in terms of access to the dollar to be punched through, because they allow, if you are some sort of merchant in Turkey, it's the ability to get a dollar denominated bank account is just frankly impossible. So these are the next best. This stablecoins are the next best way to get access to dollars in ways that you might otherwise not be able to, because you would never meet the standards or the KYC. I think this is quite intimately connected to the decline of correspondent banking as well, post GFC and post all the regulation that insisted on banks being responsible not just for their immediate counterparty, but the counterparty of their counterparty in offshore jurisdictions. So stablecoins are just like private credit has come around to fill the gap that was created through the regulation of leverage and in the conventional lending market. I think stablecoins allow for a way to work around some of these correspondent banking issues, largely related also to KYC and AML. That said, another thing that we should be mindful of is, and I find it quite fascinating too, is the degree to which Tether has become a it started off as the bad boy of finance and not to be trusted. We didn't know what their reserves were, but now they are enforcers of US international kind of dollar policy. And you've seen them very clearly move on Venezuelan accounts in the last few months. I think that was seen as quite a shock in the crypto markets, because they perceived Tether as never complying. And lo and behold, not only are Tether now super close to the Trump administration and helping to fund Trump's ballroom and whatever, they are now very willingly enforcing Trump policy in terms of whose assets are confiscated and whose assets are not, to the point that I've heard discussion about whether the confiscation of or the freezing of these Venezuelan accounts is equivalent to a Euroclear moment for Teva. Like, will is there a sort of diminishing return from being a friend of the authorities to that degree? Will they kill their own market? But Teva are very proud of how closely they now operate with police and enforcement agents. So it is, I think that's another interesting development. But of course, as and when they become more compliant, that will just create a market opportunity for new entities that are less compliant. And I'm sure they will emerge soon enough.
Let me just jump in real quickly. I would add to that list of what's driving adoption in the U.S. It's not just the passage of the legislation, sort of giving some light touch regulation and a sort of express permission to U.S. stablecoin providers. It's a complete regime shift in favor of stablecoins politically. And what I mean is not the Trump administration necessarily. It's that there was so much money in this last election supporting crypto interests. That it's been made clear to every politician that you regulate crypto, including stablecoins, at your own peril. And that's bipartisan. And so I think that that's also driving investment adoption because it's been made clear to anybody who wants to get into this space that the politics of crypto in America are not going to change. That money has been secured. They are ironically paying very real bank dollars that are supported by the FDIC and the Federal Reserve to politicians and to political action committees to make sure that only crypto-friendly candidates are elected. And so that regime shift in favor of crypto is going to outlast the Trump administration. And I think that's something to keep in mind.
I think, like, if it's circling back to use cases and trying to tie up with some stuff that Jay was mentioning, and I'm always going to come back to Minsky, why the corporates are trying to do this. Well, anyone can create money. The problem is to get it accepted. So if you're being told that, look, I'm going to be accepting new forms of money, and then you might be able to get that promise, backstop, but then why not explore? But I would say at this stage, I take all of these headlines of X exploring Y in a similar fashion as I took the We Are Exploring Blockchain in 2016, 2017 type of thing. I've yet to see kind of the hard evidence of these things being implemented. So Isa was also mentioned the issue of costs and the statements of stablecoins allowing for circumvention of capital controls. I think the evidence that I gave you on parity deviations is very much aligned with that. So the parity deviations tend to be larger for countries that have some sort of capital control. Now, if you say, like, my business case for this thing that I'm promoting is undermining the regulations that other sovereigns do for their own policy purposes, what does it tell you? I mean, in general, about what you're doing? I find this a bit strange. That number one, and then that also speaks to, like, where is the demand going to come from? So are you counting on the depression of yields by tapping demand of a corporate in Turkey that is trying to circumvent regulation, and in the meantime, I don't know, save a bit on taxes and save a bit on AML and KYC stuff? That's kind of another broader question. And that also brings me to the issue of cost, which is, I have yet to see, and I have discussed this in other fora where I try to push people to actually come up with some actual numbers for this. And I have some exploration being done in an ad hoc way with a colleague, like a true comparison of costs of remittances, like the usual, World Bank, $200 of remittances. How much are you paying? What is the cut that intermediary X is getting, and how does that compare to stablecoins? And how much of the difference in cost, if any, is not complying with KYC and AML regulations and CFT regulations? Because if that's where the cost saving comes, then I don't know, there is no real cost saving to me, I think, at least from a policy perspective. So that's one further issue I want to mention.
Can you explain why the cost saving is not there in that case?
No, I'm just saying, like, if the cost saving, if the alleged cost savings that transacting through a stablecoin brings is a function of not complying with AML, KYC, CFT, then to me it's not a real cost saving. That's all I'm saying. And I'm not saying this is not the case. I'm just saying I need to see the data. I'm a data guy. I want to see the data. I haven't seen the data. I've asked for the data. I don't find it anywhere. But I would like to see that, because that also tells you a lot about all of the initiatives that you see around. To me, like, it makes sense to incorporate a new form of money and backstop it as a function of what that money, what the purpose of that money is. If it's
Iñaki,
if it's entirely,
you're just saying it's regulatory evasion.
You said it, Perry.
I just want to.
Yeah, I mean, I agree with Iñaki, but I would also add that historically, payments and transfers have been a terrible business. It's very difficult to make money to make a profit doing payments and transfers. It is for hundreds of years. Basically, all the data we have shows that it's always neglected, and usually the state has to step in and make sure that they're adequate payments. One of the reasons, you can do two things. You can either degrade the quality of the payments, so it's not very reliable, or you can make it expensive to transfer. In the U.S., we've made it expensive to transfer, but maybe we're going to experiment with degrading the quality as well by adopting stable coins. But I'm with Iñaki. I'm convinced that there's only one innovation in finance, full stop, and it is pairing runnable liabilities with crappy assets. And we're seeing another innovation. That's what innovation is. I also sort of my question to the point of innovation for Izzy and Iñaki is there's an IMF paper that's pointing out that we can measure what's going on the blockchain, but a lot of the remittances are happening off chain, in the sense that somebody will buy a stable coin on an exchange and then transfer to someone else on the balance sheet of the exchange. And so again, the blockchain isn't even necessary for that. And what I'm wondering is, are we talking about a technology that's necessary, or are we sort of treating, or is what's happening is that companies like Binance are becoming the new Amsterdam Wisselbank, where they hold a global balance sheet and people make global transfers on their balance sheet. That's very old technology.
I would like to jump in, maybe pose a question, because I want to follow up on your discussion about the money, basically the money that was not the particularly good high quality, but I'm viewing that as addition. If you look at broad money, right? Basically, we have the traditional bank money, and then we have, if you look at broad M2, it also includes the money market. So money market evolved due to certain needs, because there's too much to talk about all the details. But let's talk about stable coin, because if you look at the money, right, stable coin is really another form of broad money. So in addition to the traditional bank fiat money, or whatever we call that. Of course, it's a little bit complicated. We studied money view. We kind of know all that. But if you look at that point of view, so now we have a different new form of money. It's performing different functions. And that function obviously need to build a certain new ecosystem with certain leverage. And there's going to be some really bad bank run, or the credit stable coin run someday, which need to be rescued down the road. But at the end of the day, before all of that happens, right, it's the end of it is credit money, right? So it's not really having all the backing yet of FDIC banking. But if you look at all the expansion of monetary system, all the potential application of this new money, so that at least that angle I'm looking at, right? So from the broad money additional feature point of view, so I did anybody think that way? Give me certain pointers on how I should think through this.
I mean, if I may here jump quickly, I think this we laid in the paper with Perry and Dan. We sort of lay this out to some extent. It's also in an appendix there. This is a promise to pay money. Like the world is full of promises to pay money. Some are more legitimate than others. Some are more trustworthy. Some will have some form of backing, which will make them more trustworthy. Some will gain trustworthiness by the repeated game nature of the exercise in which you systematically fulfill your promise. But at the end, it's a promise. So I see them as just a new promise to pay $1. And then the question to me is like, how do you defend a promise? And if you cannot defend it, then whose door are you knocking on? And is whoever is behind that door, is it answering your call for a backstop? To me, like that's a good question. So whether this would be M2, M3, I don't know. The future will tell. But the point with which we actually close the paper with Perry and Dan is saying, like, if you want to shoehorn this within the hierarchy of money, you should know that at some point the promise to pay will be tested, and in some states of the world will fail, and that will require a backstop from a higher form of money. So I think more in terms of different monetary instruments with different degrees of moneyness, which is to some extent a function of the credibility of their promise to deliver a higher form of money. And eventually, you mentioned money market fund shares. Those also started under kind of controversial beginnings as a mixture of, again, financial innovation, regulatory arbitrage. People didn't know a lot of what to do with them. There were court cases in the US, which I'm sure Brendan knows much more than I do. And eventually, that's a promise to pay that it failed. And then when you fail, you either get the validation or not. And they got the validation through money market liquidity facilities, for example. And they have been for quite a long time part of the monetary ecosystem. Stablecoins might be in the future, might not. I don't know. I mean, it looks like more increasingly that they are. But at the end of the day, it's just a promise to pay, and will it be backstop or not?
I agree with that.
It's good.
Go ahead.
So I just want to say we have 3 more minutes until we close the session. So I would like to just everybody, the speakers have a chance to sort of give their final remarks for a minute each. So whoever wants to go first, go ahead.
Well, I know that you have a South Africa session next, and I'm actually on my way to Cape Town. I have a hard stop because I've got to get to the airport. So that's fortuitous, and it's a shame I won't get to listen to the next panel, but I will hopefully listen to it on the recording. I just wanted to add 2 quick points, which is, I don't know how aware you are all of these kiosks that there are in stablecoins. Like, that is one of the key policies that Tether is pushing across emerging markets. And there's like hundreds of thousands of these kiosks now, very much following the model of M-Pesa originally, which was, I think, a type of stablecoin, really. It was like a proto-stablecoin. And those kiosks are the primary way that they interface with a lot of consumers, and obviously absorb real hard currency and cash in exchange for stable coins. And then they do like other kind of stuff. They sell other stuff like power and elements like that. And I think one of the underappreciated elements of that is that this is part of a sort of statecraft policy. I personally think Tether, they're pushing dollarization in a lot of countries for the sake of Uncle Sam, and they've now kind of it entered into an understanding where it's it serves everyone's, America's interest to push the dollar in these more volatile regions. And the last point I would say is, I think, and this is probably something for another discussion, is fundamentally stablecoins are, for me, like seigniorage arbitrage. You're issuing tokens at par and collect against collateral that that creates billions and billions in terms of returns for now. Even Circle is making a lot of money. Finally, it took a while for them to make money, but they're generating huge amounts of profits from just sitting on treasuries. And of course, after the whole Russian asset thing came into the public consciousness, I think everyone now knows that assets don't just sleep. Like, money doesn't sleep. Money is always working and it's always generating returns. I think the political class has been quite slow to pick up on that. Now they understand, and stable coins are effectively these large sort of slush funds that allow for all sorts of private entities to just benefit from seniorage. But the really interesting opportunity for the political classes is that this allows for the application of windfall taxes in a way that is less destabilizing than if you were to apply it to banks. And I like to point to the fact that when Meloni tried to apply windfall taxes to Italian banks, because of the kind of complexities and fragilities within the Italian banking sector, it made Italian bank equity completely collapse, and it was a no-go. And the compromise they came up with was this idea that the Italian banks just can't pay out dividends, and instead they've been going on sort of M&A sprees. But if it's a stable coin, and if it's a stable coin that is potentially kind of owned by European entities, then I think that's a pathway in the future to do financial repression through taxing. You can have your stable coin, but when we need it, we can tax your windfalls if they're too excessive. I think we should watch out for that. Maybe that's a bit crazy, but I think it's interesting.
So I can sum up quickly. I sort of see the story of this year as the story of a missed opportunity, which is it is absolutely true. The best use that international transfers and in the U.S. domestic transfers were hideously expensive and too expensive, and that is a problem that could have been solved, and it could have been solved with enough application of thoughtful regulation and international coordination. That is a thing that could have happened. It did not. Unfortunately, we're still stuck with the bank being the central node of regulation, of oversight. And what we have now is, because in America, we did not force the banks to make transfers cheap. And because there was no international attempt to make international transfers cheap, we're now stuck with this new unit, this new node outside of traditional banks that's got a completely different oversight regime. These things aren't going away. And now we've got an even tougher problem than the one we had before, which is there is a use case. The use case is transfers. Having not solved it at the bank level, now we have to do something that's even harder, which is re-regulate businesses, which I agree with Iñaki, are inherently profitable because they're ignoring regulations. It is regulatory arbitrage that makes these businesses go.
Iñaki?
Yeah, maybe I can just follow up quickly on a point, just to close on a point mentioned by Isa, the fact that the issue of seniorage and the massive amount of profits that these entities make. I see it more as a carry operation yes, they do have seniorage, and in particular, for example, if you think that Tether is gonna replace dollar bills held, I don't know, in the likes of my original country, Argentina, then they're definitely eating the seniorage of the US, and I think the US is very much aware of this. That's kind of a separate discussion. But they are a carry operation. They just pay zero on the liabilities, and they park it in treasuries, which, fair enough if you're allowed to do that and you have a business model for that. But that goes also to the core of current discussions about remuneration, of stablecoins, which is banned in direct form, but in indirect form, the market finds its way. Now, I heard from people within the industry, the stablecoin industry, saying no remuneration, because if we were remunerated, we would be an investment instrument, not a payment instrument. The same person, some year before that or year and a half before that, I asked the same person, okay, so let's imagine that you are a payment instrument, right? When I read Genius, I read everything in the newspaper, which is the thing that drives me crazy. Payment. And when you see the use cases that I showed you, there is no payment. So this kind of, I feel like I live in a completely parallel reality, and I'm going crazy. So if you are a payment instrument, then your main source of income should be payment fees, should not be driven by a carry operation. So that can be like a potentially very, razor thin margin, potentially profitable business model, but it's a completely different business model. So you can think of a scenario in which, the stablecoin is truly a payment instrument, and you make it super safe because it's in the interest of, the public stability and defense of par, and et cetera, et cetera. So you do something like, the Bank of England has been proposing. Namely, I will give you unremunerated reserves at the central bank. So you are not allowed to pay anything on your liabilities. You are not getting anything on your assets, and you're gonna have very thin profit margins. But if you really provide payment innovation, then those.
Well, thank you. I'm not sure if you still hear Iñaki. Iñaki was gone for a second.
Yeah, okay. Can you hear me now?
Yes, now you're back.
Yes, sorry, I had a connection issue here.
It was just 5 seconds at the end, so I think. Well, anyway, I think this is a good final statement. We're right at time, or over time, actually. So I'm very happy with the session. Thank you so much, Brenton. Thank you, Iñaki. Thank you, Izzy, for joining. And I think this warrants a lot of discussion. I think we have a lot to think about in this space. We will take a couple minutes break and prepare for the next session. And I'll stop the recording here.